Hello, everyone. This is Zach Gardezi. I'm the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So for this episode of Money Minutes, I want to share with you, an explanation as to why the stock market had a bit of a pullback today. I'll explain why that is, what my outlook is coming up, and then also what I've been discussing with Wealthstone clients and some portfolio management adjustments that I've made. So let's get right into it. So I'll start with the big news. Now, the big news is that the Chinese government has released an explanation or really a notice to countries all around the world saying, look, we're going to be putting export restrictions on more rare earth metals. Now, rare earth metals are things that are used, for example, in computers, electric vehicles, especially what we're seeing now with artificial intelligence, eventually quantum computing, everything and anything that's electronic, which ultimately makes up almost everything in our lives these days, has some sort of rare earth metal component inside of it. Now, the reason why this is a really big move, export controls have been around for a long time, is because China is now saying, look, even if this isn't a direct export out of China for the metals, if the product that you're making utilizes Chinese rare earth metals, then you need to go through China to get some sort of permitting or licensing explaining what you're using these metals for in your end product. And if that has some sort of a risk to Chinese national security, there's not an exact explanation as to what will happen, but you can make the assumption that either they won't allow you to buy those metals anymore, or there may be some sort of a tariff or levy or something placed on utilizing those products to make it more difficult for countries and ultimately companies to do that. Now, the White House had a really negative reaction to this because the Trump administration was supposed to meet with the Chinese president in a few weeks in South Korea to try and make some progress in trade negotiations. Now, rare earth metals is very important to the United States because they're utilized in, again, computers, electronics, electronic components. They're utilized in electric vehicles, artificial intelligence, regular vehicles. It doesn't have to be electric vehicles. Nowadays, virtually every vehicle has tons of computer chips inside of them. So a restriction on rare earth metals has a serious negative risk to the U.S. economy and puts a damper on some of these trade negotiations. Now, on the Chinese side, they were tactically trying to, and who knows if they'll be successful at this. Right now, it looks like it backfired, but ultimately what they were trying to do was add some more negotiating chips on the table, right? Let's put an export control on something that the White House thinks is very important. So then when they meet in a few weeks, they could say, hey, look, we'll take some of these restrictions off if you do X, Y, and Z. Now, the White House, again, had a very strong reaction to this. They put an additional 100% tariff on China, which now brings their tariff rate to about 130%. And then they also, the White House canceled the meeting with the Chinese president in a few weeks, saying, look, there's no point in meeting after this move by the Chinese. So ultimately, whatever the Chinese were trying to accomplish doesn't look like they were very successful at it. This is likely going to turn into what we normally call a trade war, where they do something, we do something, they do it back, we do it back, and things escalate until ultimately cooler heads prevail, and then they come to some sort of a deal. But in the interim, the market's going to be totally freaked out by this news, right? Like what's going to happen exactly with these tariff rates? How is this eventually going to affect imports and exports? Is this going to significantly elevate inflation rates? We're already starting to see inflation creeping back up. If these tariffs do go into effect, which the increase in the tariffs by the U.S., the 100% increase is supposed to take effect on November 1st. If they do go into effect, what's that going to do with the prices of products that we get from China? Is it automatically going to spike up? So this is going to create more fear and more panic, and that's exactly why you saw the market have a bit of a pullback today. And it's Friday. The stock market is opened on Columbus Day while the bond market is closed. So you're going to see some activity on Monday. My guess is unless we have some sort of pause or both sides agree to calm down, probably going to have some negativity going into next week as well and in the weeks thereafter, because it's not just the situation with China and trade that we're dealing with in regards to the U.S. and global economy and the stock market. At least on the U.S. side, You have the government shutdown, which is on technically day 10, going into 11 here with no end in sight. The hyper partisanship between, the Republicans and Democrats has only gotten worse. The blame game has only gotten worse. And, these government shutdowns, they typically last a few weeks. The longest, we've ever had is a little bit over a month during the first Trump administration. Now, in the beginning, the market didn't really care about the government shutdown. It was more of, this is going to end soon. Let's not worry about it. But now that we're on day 10, federal layoffs are starting to happen now. Thousands of employees are slated to be laid off, potentially even more in the coming weeks, right? Which, again, the federal government is by far the largest employer in the United States. So if they start laying off people significantly, unemployment creeps up. We already have a weak labor market. That's another risk factor in the markets. So you've got creeping up inflation. You've got a weakening labor market. You've got a Federal Reserve that's clearly uneasy by everything that's going on, right? They're dealing with this potential stagflation risk, which stagflation is when you have a slowing, weakening economy, you have elevated inflation, and you have a weakening labor market, right? These things typically don't happen at the same time. Normally, you don't have elevating, inflation with a weakening economy. Normally, if the economy is strong and really strong, you have inflation going up. And at that same time, the labor market is also typically pretty strong too. That's why the economy is strong in that type of a scenario. But right now, we have really one of the more dire situations shaping up, which is a weakening labor market, inflation going up, and economic growth projected to slow down a bit, especially the longer this government shutdown goes on. That has a negative impact to GDP, which is really economic growth. And then as long as we have, escalated trade tensions with China, that has a negative impact to economic growth, not only in the US, but globally. And then, as I've talked about over the last few weeks with clients, is you have heightened geopolitical tensions, right? You've got what's going on in Ukraine and Russia. Why are we seeing drone incursions in other NATO countries? Is that war about to escalate into other European countries? And what will the impacts of that be? Of course, they would not be good for the global economy. So putting all of these risks together, and this is the conversation that I've had with clients over the last few weeks, what I did for Wealthstone clients is, where appropriate, I sold stock exposure, because our stock exposure, we still are invested in some of the best parts of the market. Tech, artificial intelligence, these areas have done really well. So, my client stock exposures started to go beyond our comfortable target ranges. So I had a conversation with clients over the last few weeks. Really, this started in July and August, and ultimately decisions were made in mid to late September to start to rebalance client portfolios. I saw a lot of this risk starting to materialize in the economy and the market, and I reached out to clients and let them know, hey, look, I'm going to start rebalancing. I want to bring down our stock exposure to actually lower than some of our normal target ranges. And in addition to that, as I saw weakening labor market reports, I started to raise cash levels as well, something that I don't normally do in client portfolios. But after really seeing the confluence of all of these negative things happening at once, it made sense to me that, look, we're at all-time highs in the market. It makes sense to have a decent cash position heading into the later parts of the year to kind of ride out exactly what I think would happen, which is some short-term negative market events. And that's exactly what we're starting to see play out now. Now, again, the key point here is it's short-term. My intermediate to long-term outlook still remains very strong. You've got the Federal Reserve. Although inflation's, starting to creep back up, the Fed thinks that inflation is more, I hate to use the word because it has a bad, sort of history to it now, but the Fed still thinks that this tariff-related inflation is transitory. It's going to be temporary. It's sort of like a one-time shock. And if that's the case, we should see, and we see this in the Fed's projections, inflation creeping up a little bit and then getting back down eventually to the Fed's 2% target. So think of the inflation risk as short-term as well. The Fed still has optimistic economic growth projections, despite all of the crazy headlines that we're seeing. And it's not expected that unemployment gets out of control either. Really, unemployment shouldn't creep up too much from here as long as the Fed continues to lower interest rates. Inflation remains rather tame. That should help stave off any deterioration or significant deterioration in the labor market. So putting all those things together is why I think some of the short-term noise that we're seeing could be potentially buying opportunities for investors. That's how I'm looking at it. Of course, every client's different stage of life, different types of financial plan and goals. And so as a financial advisor, you really have to look at your client portfolios, uniquely, individually, and figure out, okay, is this a buying opportunity for this client? Is this client appropriately positioned? And make those kinds of decisions that I make for every client at Wealthstone. Now, in addition to some of the economic indicators that I'm talking about, you also have exactly what we're seeing in the market, which is artificial intelligence continuing to post record numbers. And you're starting to see a lot of optimism in the quantum computing space, which I wrote an article earlier in September talking about what's the next big thing after AI. And I believe it is quantum computing, which we'll talk about more in the coming future, I'm sure. So now, as the market starts to go through some of this negative downturn, you're going to see some of the areas of the market that led the way, such as tech and artificial intelligence, lead the way down too. These are sensitive parts of the market. As the market goes up, you see tech really lead the way. As the market goes down, tech typically leads the way down as well. So again, think of it, in my opinion, this is how I'm viewing it, as potentially a buying opportunity. Now, when you buy, how much you buy, how do you adjust your portfolio? You really need to speak with your financial advisor to figure out how to take advantage of exactly what's going on in the market right now. But overall, my intermediate and long-term outlook remains strong. And for Wealthstone clients, for those who this was appropriate for, we should feel very good about our positioning right now, because we were able to raise cash at the perfect time, in my opinion, where the markets were elevated, nearing their all-time highs. Now we're sitting on cash, waiting for the market to even have some more downturn. If that's the case, great. We'll go in and buy a lot of these stocks that we like and have done really well in at lower prices. And then we'll see the intermediate and long-term outlook play out, which is lower rates, good for tech, good for AI. And we should see the market hit some of these really high targets that we're starting to see from Wall Street firms. But again, the short-term noise that we're seeing is going to have even more volatility, I think, in the coming weeks. But it's not something that investors should really be too alarmed about, because again, it's just one of those things. Like earlier we saw in April, you had a ton of volatility as we saw the global tariff rates get announced. The market took a massive drop and then proceeded to have a very strong, one of the strongest recoveries we've seen in a long time after a sharp correction. And so I think we're going to see much of the same here. It's all about timing, and it's all about making sure that you stay within your plan. Don't get too aggressive. And if you have any questions, Wealthstone clients, of course, can always reach out to me, and anybody else. If you'd like me to review your portfolio or answer any questions you might have, please feel free to reach out. But hopefully this video helps you understand what caused the market to have its pullback today, and then all of the different factors that are affecting the market right now, and what my overall outlook is. So thank you for tuning in, and I hope you all have a great day. Thank you very much.